Hi, I'm Don Marleau. I'm the sector lead for metals and mining at S&P Global Ratings. I'm part of a global team that covers credit ratings on more than 115 metals and mining issuers around the world. I've been covering metals in North America since 2004. I'd like to take this time to thank the New York section of the S&P for the invitation to speak today. So to kick off, looking at the global portfolio of credits that we cover, first of all, I'd highlight on the left chart the single A to triple B categories, which represent about 40% of our credit ratings. As you can see, the 60% is the riskier speculative grade segment of the industry, and that highlights volatile earnings, capital intensity that can drag on long-term returns and credit performance. These are inherent business risks across the rating spectrums, but across the rating spectrum tend to be more acute in the spec grade. This rating distribution, however, has been pretty steady for a few years. We've had some tumultuous times with difficult market conditions running from 2018 through 2020. On the flip side, these companies have exhibited pretty good financial discipline, which has helped offset these difficult market conditions and has supported credit quality. The chart on the right side shows a slight positive bias, which is an unusual stance for this industry. It's the first time in more than 5 years that we've had this slight positive bias. Again, this reflects the combination of several years of financial discipline with the current improvement in market conditions that's yielding record prices and record cash flows for some issuers. As you can see here, upgrades are outstripping downgrades by a rate of about 3 to 1 so far in 2021. We had pretty much the flip side of that in 2020 owing to poor market conditions from the pandemic. This positive momentum really has been confirmed with these upgrades, but they're mostly for low-rated, riskier credits. These credits tend to rely on financial windfalls, where higher-rated credits typically have more stable cash flow through the cycle. And at the same time, current high prices don't indicate widespread rating upgrades immediately. Extraordinary cash flow gains like we're seeing right now are often fleeting and often don't sustainably bolster producers' credit quality. There are a few factors for that. First of all, strong credit ratios in current market conditions really only last as long as metal prices remain high without some sort of improvement in competitive positions or debt reduction. Second, we expect that metal shortages could prompt higher capital or operating spending as these companies seek to increase output while cash flows are strong. And finally, the most aggressive corporate development decisions, like risky greenfield projects or acquisitions with debt-funded premiums, often occur during phases of tight market conditions, perceived scarcity, and high price expectations. So looking at the shape of the recovery in market conditions for metals, we see that good demand and bullwhip restocking have sparked a persistent 30 to 60% surge in most metals prices, with steel backlogs holding at historical highs. The turnaround could provide a catalyst for further transformative investment to improve assets and competitive positions. And global cost pressure, trade, and ESG considerations imply significant new investment in a mature industry. So the credit buffer was unusually good coming into the most recent downturn in 2020. Balance sheet repair since 2018 didn't turn into large debt-funded corporate development like in past cycles. Debt leverage was low compared to previous cyclical peaks, which allowed for rapid improvement recently with an upside surprise in market conditions. And that really leaves us to, big cash flow enables big decisions. Steelmakers in the US are undergoing a strategic overhaul, rationalizing capacity, reducing emissions, and maybe even boosting profits in the long term. And of course, as we've heard recently, 2 new electric arc furnaces are announced in the US in the last 2 weeks alone. So ESG factors will be important the next wave of heavy investment in this volatile industry. Within the context of stronger cash flow and improving credit profiles, ESG considerations are emerging as decisive for issuers in metals and mining. Excuse me. So the key takeaways as we dive into ESG and credit ratings are, first of all, ESG factors have always been considered in our credit ratings. Just as an example, environmental factors in metals, for example, like the treatment of asset retirement obligations, have been applied as a debt-like obligation. So this shows that we've been looking at the business costs and the financial liabilities of these environmental remediation costs for many years. The second takeaway is that ESG is affecting corporate decision-making, corporate strategies, and capital allocation. And finally, ESG is affecting credit ratings. So an S&P Global Ratings issuer credit rating is a forward-looking opinion about an obligor's overall credit worthiness. It assesses the obligor's capacity and willingness to meet its financial commitments in full and on time. ESG credit factors, on the other hand, occur at the intersection of ESG factors, which we'll talk about, as well as these credit factors, of course, which I'll get into as well. So we define ESG credit factors as environmental, social, or governance factors that influence the capacity and willingness of an obligor to meet its financial commitments. This influence could be reflected through a change in the size, relative stability of projected revenue, its operating requirements, profitability and earnings, cash flow and liquidity, or the size and maturity of its financial commitments. This chart shows the scope of ESG-related rating actions across S&P's corporate ratings universe in 2020. As you can see, we had 335 downgrades around the world for an ESG factor or another from April through December. Now, the important thing to note in this performance for ESG factors is really that half of these were in pandemic-hit industries like transportation, hotels, and restaurants. In fact, we saw a limited ESG effect on metals and mining issuers in 2020, taking into account the fact that these ESG issues like environmental factors have been prevalent for many years and did not turn acute in 2020 that compelled rating actions. This shows a breakdown of our key ESG factors that we incorporate when we're considering credit risk. So some of the environmental factors we consider are the greenhouse gas emission factors, including CO2, natural factors like weather events, other emissions for water or air, as well as other environmental factors, including land use, water use, that are prevalent in metals and mining space. Social factors, again, are quite prevalent in metals and mining. Health and safety factors are important for financial and reputational damage. Consumer factors can lead to also to some reputational issues. And in metals and mining, human capital management, such as employee disputes in a highly unionized environment, are important. And finally, overarching social factors like community relations are vital in the mining industry. Strategy, execution, monitoring factors are key to our governance assessments, and these are critical ratings items for many years. Risk management and internal control factors, transparency factors, including disclosure, which will be increasingly important as sustainability takes hold. And finally, board-related factors, including composition, independence, and turnover, which can drive corporate decision-making, are key governance factors for S&P. So when we consider these ESG credit factors, this is a map of our corporate criteria framework, and we want to highlight where it is we take these ESG considerations into account. First of all, at the industry risk level, we take into account risks like risks to growth, margin trends, or substitution, all of which have played a role in the metals and mining industry risk. And as we see changes in metals demand, it will play increasingly a role going forward. The competitive position is ultimately the strength, in our opinion, of a strength of a company's business risk profile. So this really often depends on things like positioning within a metal, the quality of reserves. Point out simply the difference in metal exposure, for example, like coal versus aluminum. Coal, which has been in secular decline in North America and faces a decline globally eventually. Compare that to aluminum, which has turned a bit of a resurgence as a packaging alternative to plastics, or for lightweighting compared to steels in the automotive industry. Competitive advantages in here can also come from tailwinds for metals like copper and nickel, which play significantly in the electrification story. On the flip side, blast furnace steel operators have been competitively challenged for several decades, to the point where we're seeing environmental factors drive a meaningful strategic shift in North America as well as globally. Ultimately, the breadth of earnings and the efficiency of this earnings profile is what we're trying to assess in a company's competitive position. And this leads us in turn to a consideration of cash flow and leverage, basically the company's cash flow stability and its debt usage. In that respect, ESG factors have already influenced the business factors, but also can drive financial performance. And we'll see that going forward as increasing capital expenditures will be required to pivot to reduce the carbon intensity of operations. And finally, our criteria explicitly address key management and governance factors which can affect rating outcomes. So changes in competitive position are probably best highlighted in the US coal industry. Here we've seen a secular decline in demand in North America and likely pressure globally. As that has occurred to some of these companies, or many of these companies, it has caused limited strategic options, and weak access to capital limits the prospects for earning their way out of a deteriorating credit story. But here we can make some distinction. Some coal markets are not declining. For example, some thermal markets in Asia are steady to growing, even if the long-term sustainability may be in question. Also, metallurgical coal, steel-making coal, remains key to the production of steel. So this, I think, highlights where ESG risks are uneven, even for an industry that appears on the surface as difficult as the coal industry. So this leads us into base metals and precious metals, the mined metals. Of course, environmental factors have always been critical here in terms of land use, and increasingly water use, given where some of these deposits for the vital metal of copper occur in Chilean deserts and so on. This industry has high capital intensity for mining and high cost intensity for the processing, and both of which imply significant resource usage. So we have these sort of ever persistent environmental factors, whether it be land, water consumption, emissions, or chemicals inputs. So in base and precious metals, however, the environmental risks cut both ways. Environmental and social risks cut both ways. As I've mentioned, the metals like copper, nickel have a good supply-demand balance, and demand for electrification compared to we have to consider the tailwinds from demand for electrification against the costs associated with land and water use from increasingly remote copper mines. And we would expect similarly favorable demand tailwinds for cobalt and lithium. But again, these assets are highly idiosyncratic so that any demand pull can be exposed to things like production availability, oversupply, undersupply, as well as capital exposures, such as capital expenditures and mine plans that have a difficulty meeting global output expectations. So the overarching industry risk for metals and mining ranks as a 4. This is not to confuse the viewer with too much credit rating jargon, but it's on a scale of 6. Recently, we updated some scores for numerous industries, and one thing that emerged is that given the risks to profit margin trends, the risk of secular change and substitution, and the risk and growth trends, we actually moved our oil and gas E&P sector down to the same business risk, same industry categorization as metals and mining. Metals and mining itself already reflects extraordinary volatility, high capital intensity, as well as some question marks around risks to growth trends, considering climate change and use of coal in many of the products. And as we can see here, this really, in a way, confirms where we've been on metals and mining, and that this transition in oil and gas to a higher risk categorization is reflected in the industry returns. So you can see over the last 10 to 15 years, returns have deteriorated, taking into account things like environmental pressure, increasing adoption of renewables, and the inherent volatility of hydrocarbon prices, just like metals. So moving from the mined metals into steel and aluminum, ESG factors really underpin the credit story for 2021. First of all, integrated steel producers in the US are undergoing a strategic overhaul by rationalizing capacity and reducing emissions. The competitive position of coal-consuming blast furnaces in North America and Western Europe has been degrading for several decades. Steel mills in North America have access to a natural endowment of iron ore and metallurgical coal that should support domestic output, but these advantages can often be overwhelmed by excess capacity elsewhere with lower costs. Output from China, however, could ease to support environmental and economic transition targets, but decades of overcapacity loom in this industry. Marginal production everywhere is being weighed increasingly by emerging costs of carbon emissions and other pollutants. So we would expect that the credit quality of a few steelmakers in North America over the next few years will hinge on the ability to extract financial gains from some defining strategic environmental decisions recently. So as you can see here, the shift in the US industry really is based on the shift from coal-intensive blast furnaces to electric arc furnaces. The chart on the left shows the relative CO2 per ton of steel production. And as you can see, it's no comparison. The transition to a lower carbon footprint surely implies more electric arc furnaces. That said, the chart on the right shows that the US has already penetrated quite significantly with EAFs, so that only about 30% of the steel comes from blast furnaces. places like China, where the lowest cost steel capacity in the world is, most of it is produced from blast furnace. So there is a meaningful transition that needs to come globally in this respect. And we can see even companies in North America have been gradually reducing their output from blast furnaces by way of closing steel mills and investing in electric arc furnaces. Most notably, US Steel recently announced a $3 billion investment in a potential new steel mini mill in the United States. Same with aluminum. Again, this highlights the importance of the electricity source for a product when you consider whether it's electric arc furnace steel or aluminum. These are both highly electricity intensive products. So they've eliminated coal and they've substituted for electricity. The issue comes down to what's the source of electricity. And as you can see, in the EU and North America, it's largely hydro for aluminum, but that shifts more to other sources, including coal in the rest of the world. So transition to greener aluminum, again, is a heavy burden on the Chinese industry, which is in fact occurring. We see Chinese smelters being repurposed and repositioned, being moved from coal-fired generation to more hydro-fired generation. But these transitions take many years to occur. So to summarize, ESG factors are an increasingly important consideration for metals and mining companies as secular forces drive demand for products and supply of capital. S&P Global Ratings has ESG factors well entrenched in our credit opinions. Factors like reserve quality, regulatory oversight, local pressure have always informed our competitive positioning. Volatile profits and large capital requirements are often affected by the management of factors like environmental remediation, labor relations, or community relations. I hope my presentation has been informative. I'm Don Marleau from S&P Global Ratings. Thanks for your time.